Ever stared at your bank account and seen that magical six-figure number staring back at you for the first time? Congratulations. You've officially joined a club that most people never reach. But here's the thing that nobody tells you about hitting $100,000. Having the money is actually the easy part. Knowing what to do with it without completely screwing up your financial future is where things get interesting. You've probably spent years grinding, saving every dollar you could, maybe eating more ramen noodles than any human should consume, all to reach this milestone. And now that you're here, you're faced with a problem that sounds ridiculous to anyone still living paycheck to paycheck. What do you do when you actually have money to invest? The internet is full of advice ranging from brilliant to completely insane. Like some guy on social media will tell you to put it all in cryptocurrency. Your neighbor thinks you should buy rental properties, and your financial advisor is probably pushing some expensive mutual fund that makes them rich while keeping you average. My name is Nick, and I help people understand how money actually works instead of how financial institutions want you to think it works. If you're sitting on $100,000 and want to make decisions that will actually build wealth instead of just making other people wealthy, make sure to subscribe and hit the like button if this information helps you avoid some expensive mistakes. The truth is, most people who reach $100,000 in savings make the same critical errors that keep them from ever reaching serious wealth. They either get paralyzed by too many options and do nothing, or they get overconfident and make moves that sound smart but are actually terrible for their situation. Today I'm going to walk you through exactly what you should do once you hit this milestone. And more importantly, what you absolutely should not do if you want that 100,000 to become a million or more. But first, let me destroy a myth that's probably floating around in your head right now. Having $100,000 does not make you wealthy. I know that sounds harsh, especially if you've worked your ass off to get there, but it's the truth you need to hear. $100,000 makes you financially stable, which is awesome, but it doesn't make you rich. The difference between those two things determines whether you'll spend the rest of your life working for money, or whether money will start working for you. Here's what most people don't understand about reaching six figures in savings. You're not at the finish line. You're not even halfway to the finish line. You're at the starting line of actually building wealth. This is where the real game begins, and the moves you make from this point forward will determine whether you retire comfortably or work until you die. The first thing you need to do, and this might surprise you, is absolutely nothing, at least for a few weeks. I know that sounds crazy when you've got all this money burning a hole in your account, but hear me out. The biggest mistake people make when they hit 100,000 is immediately rushing to deploy all of it because they're afraid of missing out on returns. They've been saving for so long that they think any day not investing is a day wasted. This impatience leads to some spectacularly bad decisions. Take a step back and think about your complete financial picture. Yes, having six figures saved is incredible, but what does the rest of your situation look like? Are you carrying any debt? Do you have a solid emergency fund separate from this money? What are your income prospects? What are your actual financial goals beyond just having money? These questions matter more than whatever the stock market did yesterday. The second thing you need to do is optimize your foundation before you even think about investing. This isn't sexy advice, but it's the difference between building wealth and staying middle class forever. If you don't have a proper emergency fund, you need to carve out a portion of that 100,000 for this purpose immediately. I don't care how boring it sounds or how little interest you're earning. Your emergency fund isn't an investment. It's insurance against life punching you in the face when you least expect it. How much should you set aside? The old rule of 3 to 6 months of expenses still applies, but with a twist. If you're single, have no dependents, and work in a stable industry, 3 months might be enough. If you're married with kids, own a home, or work in a volatile field, lean closer to 6 months. Some people think having money invested in the stock market counts as an emergency fund because they can sell if needed. These people have never experienced a real emergency during a market crash. When you lose your job and the market is down 30%, you'll understand why cash is king. But here's where it gets interesting. You don't just stuff this emergency fund under your mattress or leave it in some checking account earning nothing. High yield savings accounts are currently offering rates that haven't been seen in over a decade. We're talking about 4 to 5% annual returns on money that's completely safe and accessible. That's real money on significant balances, and it's money you can access immediately if something goes wrong. Let's do some quick math that will probably surprise you. $10,000 in a traditional savings account earning basically nothing generates maybe $10 per year. The same $10,000 in a high yield savings account earning 5% generates $500 annually. That's enough to cover a month of groceries or several months of utility bills just from interest on money you need to keep liquid anyway. The third critical move is eliminating any high interest debt before you invest a single dollar. I know this advice is about as exciting as watching paint dry, but it's mathematically essential. If you're carrying credit card debt at 20% interest while investing in the stock market, hoping for 10% returns, you're literally paying someone else to make you poorer. The guaranteed return from paying off high interest debt beats the uncertain returns from any investment. This becomes especially important when you consider the psychological aspects of debt. Carrying debt while trying to build wealth is like trying to fill a bucket with a hole in the bottom. Even if you're making good returns on your investments, those monthly debt payments are constantly draining your cash flow and limiting your options. Debt elimination provides something that investments never can: guaranteed returns and immediate cash flow improvement. Here's where most people mess this up. They want to keep their debt and invest simultaneously because they're worried about missing out on market gains. This is emotional thinking disguised as mathematical reasoning. The reality is that eliminating 20% interest debt gives you an immediate 20% return on your money with zero risk. Show me an investment that guarantees 20% returns with no risk, and I'll show you a scam. The fourth thing you need to understand is the power of tax-advantaged accounts, and this is where most people leave serious money on the table. If you haven't maximized your contributions to retirement accounts, you're essentially declining free money and paying unnecessary taxes. The contribution limits for these accounts increase every year, and they represent some of the most powerful wealth-building tools available to regular people. For 2025, you can contribute over $23,000 to a 401k with additional catch-up contributions if you're over 50. Traditional IRAs and Roth IRAs allow additional contributions, and health savings accounts provide triple tax advantages that make them incredibly powerful for long-term wealth building. These aren't just retirement accounts, they're wealth-building machines that let you legally avoid paying taxes on investment growth for decades. The decision between traditional and Roth contributions depends on your current income level and expected future tax rates. If you're in a high tax bracket now and expect to be in a lower bracket in retirement, traditional contributions make sense. If you're early in your career or expect tax rates to increase, Roth contributions let you pay taxes now at lower rates and withdraw everything tax-free later. But here's the part that will change how you think about these accounts. The contribution limits aren't just suggestions. They're opportunities that expire every December 31st. Miss them, and you can never get them back. That unused contribution space is gone forever, along with decades of potential tax-free growth. The fifth crucial decision you need to make is choosing your investment strategy, and this is where people either build generational wealth or become cautionary tales at dinner parties. The investment world is designed to separate you from your money through complexity, fees, and emotional manipulation. Everyone wants to sell you something, and most of it is garbage wrapped in fancy marketing. Here's what the financial industry doesn't want you to know. The most boring investment strategy consistently outperforms the exciting ones. While some guy on YouTube is telling you about his secret stock picking system, and your brother-in-law is bragging about his cryptocurrency gains, the wealthy are quietly putting their money into simple index funds and watching compound interest work its magic. Index funds aren't sexy. They don't give you stories to tell at parties. Nobody's going to be impressed when you say you own the entire stock market through a single fund. But you know what is impressive? Actually having money when everyone else is broke. Index funds like the S&P 500 have averaged around 10% annually for decades, including through wars, recessions, and market crashes that made grown investors cry. The math on this is stupidly simple, yet most people ignore it. $100,000 invested in an index fund averaging 10% annually becomes over $260,000 in 10 years without you adding another penny. In 20 years, it becomes over $670,000. In 30 years, you're looking at over $1.7 million. This isn't get rich quick. This is get rich inevitably, assuming you don't do anything stupid. But here's where people mess this up. They think they can beat the market by being clever. They want to time the market, pick individual stocks, or follow some guru's trading signals. 90% of professional fund managers can't consistently beat the market, but somehow Dave from accounting thinks he can do it while working a full-time job. The arrogance is breathtaking. Dollar cost averaging becomes your best friend when investing large sums. Instead of throwing all 100,000 into the market at once and praying you didn't buy at the peak, spread your investments over several months. Maybe invest 20,000 per month for 5 months or 10,000 per month for 10 months. This strategy reduces the risk of investing everything right before a market crash and having to watch your account balance crater. The sixth thing you need to understand is diversification, but not the kind that financial advisors usually push on you. Real diversification isn't owning 50 different mutual funds that all basically hold the same stocks. It's spreading your risk across different types of assets that react differently to economic conditions. Real estate deserves serious consideration when you're working with six figures, not because you need to become a landlord and deal with tenants calling you at midnight about broken toilets, but because real estate provides something that stocks don't: leverage and inflation protection. With $100,000, you could put down payments on multiple properties and control assets worth several times your initial investment. Let's say you use that $100,000 as down payments on 4 properties worth $80,000 each. You now control $320,000 worth of real estate with your original investment. If those properties appreciate by just 5% annually, you're earning $16,000 in equity growth on your $100,000 investment. That's a 16% return, and we haven't even talked about rental income yet. But direct real estate investment isn't for everyone. If you don't want to deal with property management, maintenance, and tenant issues, real estate investment trusts give you exposure to real estate without the headaches. REITs trade like stocks but own income-producing properties like apartments, offices, and shopping centers. They're required to pay out most of their profits as dividends, making them excellent sources of passive income. International diversification also matters more than most people realize. The United States represents about half of the world's stock market value, which means there's another half of opportunities in other countries. International funds give you exposure to companies and economies that might outperform when the US market struggles. The seventh and most important thing you need to do is develop systems that prevent you from sabotaging yourself. Having money is easy. Keeping money and growing money requires discipline that most people simply don't possess. The financial industry, social media, and your own emotions will constantly try to convince you to make changes that benefit everyone except you. Set up automatic investments that move money from your checking account to your investment accounts without requiring any decisions from you. Automate your retirement contributions, your emergency fund deposits, and your taxable investment accounts. When investing becomes automatic, you remove emotion from the equation. You can't panic sell during market crashes if your money is automatically buying more shares every month. Create rules for yourself and follow them religiously. Maybe you decide to rebalance your portfolio once per year and never touch it otherwise. Maybe you commit to increasing your investment contributions every time you get a raise. Maybe you promise yourself that you'll never check your investment balances during market volatility. Whatever rules you choose, stick to them even when every instinct is telling you to do something different. The biggest enemy of wealth building isn't market crashes or economic recessions, it's your own behavior. People who build serious wealth over decades aren't necessarily smarter or luckier than everyone else. They're just better at not doing stupid things with their money when emotions run high. Understanding fees and expenses becomes critical when you're working with larger amounts. A 1% annual fee might not sound like much, but on a $100,000 portfolio, that's $1,000 per year. Over 30 years, assuming 7% growth, that 1% fee costs you over $60,000 in lost returns. Multiply that across multiple accounts and expensive investment products, and you're talking about enough money to buy a house. This is why low-cost index funds are so powerful. Instead of paying 1 to 2% annually in fees, you might pay just 0.03%. The difference in fees alone can add hundreds of thousands to your net worth over decades of investing. The financial industry doesn't advertise this because their profits depend on you not understanding how much those fees actually cost you. Tax efficiency also becomes increasingly important as your wealth grows. Every dollar you pay in unnecessary taxes is a dollar that can't compound and grow for your future. This goes beyond just using retirement accounts. It means understanding which investments to hold in taxable accounts versus tax-advantaged accounts, when to realize losses to offset gains, and how to structure your investments to minimize your annual tax bill. But here's what nobody talks about when discussing six-figure investments: the psychological shift that happens when you stop living paycheck to paycheck and start building real wealth. Suddenly, you have options that didn't exist before. You can take calculated risks because you have a financial cushion. You can say no to jobs or opportunities that don't align with your goals because you're not desperate for every dollar. This financial cushion changes everything about how you approach opportunities. When someone offers you a business partnership or investment opportunity that requires some capital, you're not automatically excluded because you're broke. When a great deal on real estate comes along but needs a quick close, you can actually act on it instead of watching someone else get rich while you scramble for financing. Having money also protects you from making desperate decisions that poor people are forced into every day. You don't have to take the first job offer that comes along because you need to pay rent next week. You don't have to sell investments at the worst possible time because you need cash for an emergency. You don't have to pay ridiculous interest rates on loans because you have no other options. But with great power comes great responsibility, and the responsibility is not to blow it all on stupid stuff that makes you feel rich for 5 minutes. The temptation to upgrade your lifestyle the moment you hit six figures is overwhelming. Suddenly, that expensive car doesn't seem so expensive anymore. That luxury apartment starts looking reasonable. Those designer clothes feel like something you deserve after all your hard work. This lifestyle inflation is exactly what keeps people stuck in the middle class forever. No matter how much money they make, they hit a new income level or savings milestone and immediately find ways to spend it all. They mistake having money for being wealthy, and they end up right back where they started, except with more expensive problems. The wealthy understand something that most people never figure out. Your lifestyle should be based on your passive income, not your net worth. Just because you have $100,000 doesn't mean you can afford to live like you have $100,000. That money needs to work for you, not get spent on things that make you temporarily happy but permanently broke. Here's a reality check that might sting a little. If you took that entire $100,000 and spent it on lifestyle upgrades, cars, vacations, and other consumption, you'd have nothing to show for it except memories and maybe some photos on Instagram. But if you invest it wisely and let it grow for 30 years, you could have over $1.7 million. That's the difference between thinking like a consumer and thinking like an investor. The compound interest on properly invested money becomes absolutely ridiculous over long time periods. That $100,000 earning 10% annually doesn't just grow to $110,000 after 1 year. It grows to $110,000, then $121,000, then $133,000. Each year, you're earning returns not just on your original investment, but on all the previous returns too. There you have it, 7 moves that separate people who stay broke from those who actually build wealth. Follow these steps, resist the urge to do anything flashy, and in a few decades, you'll be laughing at everyone who's still arguing about cryptocurrency on Twitter while you're sipping coffee on a beach somewhere, financially free and loving life.